Hello there. I'd love to welcome you to this healthy stream. My name's Luosi Forex, and yeah, I'm here presenting to you, representing Booster Charts YouTube channel. Before I go on, I'd love to thank my mentors, Robert Kiyosaki, who wrote the book Rich Dad Poor Dad, Tim Sykes, who wrote the foreword to the book, the Penn Stock Course, and finally Robert Kiyosaki, who wrote the book Rich Dad Poor Dad. So today I just want to dive straight into this because I literally wrote this sketch down here. Okay, I wrote it for you. So this is how to trade, candlestick patterns. So let's just dive straight into it. Now, I made this sketch for your viewing pleasure. Now, the problem with trading candlestick patterns, there's a huge problem, especially when you are trading it using Finvies, right? So there's this thing, it's called pattern randoms. All right, so not all patterns are perfect, right? So what happens in Finvies, this is what will happen to you usually most of the times. Let me show you. So when you come to Finvies, right, you come here to screener. So the mistake that many people they make, all right, is because there's something called the rocket booster strategy, which I use a lot. I'm pretty known for the rocket booster strategy in the industry. So when you come here to Finvies, you come here, all right. When you come to the technical page, all right, on Finvies, because remember that's what you are trying to use, all right. So when you come here, the first thing you'll notice is this candlestick chart right here. We can zoom in just to make it a bit clear. All right, so there you go. So the first thing that you will notice is this candlestick pattern right here. So what happens most of the times is people use the 50-day moving average, the 200-day moving average, and then they use the candlestick pattern. So what appears is this pattern here. So now in this example, we're using a bullish counter attack. So this candlestick pattern is called the bullish counter attack. Okay, so you say the price should be above the 50-day moving average, then the price should be above the 200-day moving average, then the 50-day moving average should be above the 200-day moving average. So this is called the golden cross. All right, now what happens is this, all right, and this is why I'm saying you should not trade this pattern. We call this pattern randomization. So I'm going to show you how pattern randomization looks like. So when you come here, for example, I'm going to pick, by the way, if you want the bullish candlestick pattern called the counter attack, just click the link in the description or in the chat to get the counter attack. So the counter attack is not here on the free account. So for you to get the counter attack bullish candlestick pattern, the one that you are seeing here, for you to get this bullish candlestick pattern, the counter attack, the one that you are seeing right here, you need to sign up for a Finvies account. So I'm going to show you something which is a common mistake that I used to make, because I used to make this mistake a lot, especially when I started trading. So in this case, we're going to use a bullish candlestick pattern called the hammer. Okay, so we select the hammer, and then we say, okay, because the rocket boost strategy, so you say, okay, price above the 50-day moving average, because remember the rocket booster strategy is price should be above 50-day moving average and the 200-day moving average, and then also the 50-day moving average should be above the 200-day moving average. So there we've said price above 50-day moving average. Then we have said, then we come down here, we say price, we say the 200-day moving average should be below the 50-day moving average. Okay, so here we're saying the price should be, the 200-day moving average should be below the 50-day moving average. So now if we come here to the description, all right, you go to the description. Okay, now if when we come here to the description, then we select, let's say for example, in this case we'll select S&P 500. Those are the common ones that are announced on these mainstream media channels. Okay, now I want to show you something. Let's do this. They're what you call random patterns. Alright, so let's say for example, we'll just pick on a pattern. We'll pick on any pattern. Okay, so basically what I'm trying to show you, because you're probably wondering what I'm trying to show you. Basically what it is the pattern it's not touching the 50-day moving average. You see, it's not touching the 50-day moving average, and then because that bullish candlestick pattern, right? Like in this case, you're looking at something called the counter attack. All right, so COUNTER. Just excuse my handwriting. So in this case, you're looking at something called the counter attack. Now, if you notice, the pattern is not touching the 50-day moving average. So the way trading works is this pattern has to touch the 50-day moving average like this. You see what I mean? It has to touch it. Okay, so it's either by the week or by the body, right? So the body or the wick touches the EMA. This is the golden cross. So this is the one that you trade. All right, so this body has to touch the EMA. So I'm going to show you a random pattern. So first I'm going to show you how this pattern looks like. This is the one you're not supposed to trade. Okay, you don't trade this one. Let me show you how it looks like. So this is an example. So let's turn it into white. So in this example, the pattern is not touching the 50-day moving average. Okay, so SEPN pattern. Sorry, pattern. SPEN pattern. So SPEN is an example of a random pattern. So a random pattern, basically, it does not touch. By the way, if you're experiencing a poor stream, just rewind the stream to 1 minute behind. Okay, just rewind the stream to 1 minute behind if you're experiencing a poor stream. So if you look at this pattern right here, notice that it is not touching any of the moving averages. It's not touching the 20-day. This is the 20-day moving average here. So this hammer is not touching the 20-day moving average. It's not touching the 50-day moving average, and it is not touching the 200-day moving average. So we call this random patterns, and this is what you want to avoid. You want to avoid this, all right? You want to avoid this here, the random pattern. You want to avoid this part here. Instead, what you want is to trade this, all right? You want the wick to touch that, okay? You want the wick to touch that. Then you want the golden cross. So this is the one that you trade. So here I wrote down, I said the bullish counter attack pattern must either sit on the 50 EMA. EMA stands for exponential moving average, but Finviz uses the SMA. SMA stands for simple moving average. They're just the same thing, okay? So the candlestick pattern must either sit on 50 EMA with its body all right. Excuse me. So it's with its body or its shadow, all right? So in candlestick land, this body wick is called a shadow, okay? So with its body or its shadow must at least touch the EMA, otherwise I ignore the signal. So this is my trading rule. So my rule is this should touch. If they don't touch, then you end up with something called a random pattern, like here. All right, this is a random pattern. You see, it's not even touching any of the moving averages. So if you enter this trade, then you will lose. All right. So we go further. Now we have other things that you can use. So you can also make sure the price is between the when you're using the RSI, the relative strength index, which is found on Finviz. Make sure it's between 40 and 60 RSI. Make sure there's a large amount of volume, and then also make sure the golden cross is there. So with Finviz, unfortunately, it's difficult to see the volume increase on the screen, but I'll show you an alternative way that you can catch this volume increase. And it's also difficult to put this range here. So I'll show you another way that you can apply these two. All right. So here I finish it off and I say only take a bullish counter attack if the body or wick touches or sits on the 50 EMA while price is above the golden cross. So that's what you want. Okay. So this is a random pattern. Let me see if I can show you. Let's see what we have. So let's go to the next one. Let's go to the next one here. So now I'm going to show you how to trade this pattern on Finviz. Okay. Now I'm going to show you how to trade it on Finviz. Trying to look for another example of how it looks like. So the key is to avoid random patterns. Right, so this is how you trade it. So make sure that when you come to a screener, right, when trading your screener, then you're on the 50-day moving average there. Make sure you say price has crossed above the 50 EMA. So in this case, you are saying 50 SMA, all right? That's number one. Number two, make sure the 200-day is below the 50 EMA. Number three, choose a candlestick pattern, a bullish candlestick pattern. In this case, we have chosen the hammer. Okay. In this case, we have chosen the hammer. Number three, choose the index. Make sure it's SP 500. Okay. Number five, make sure the RSI is between 40 and 60. Now, in order to implement this 40 to 60 RSI, make sure the price is below the 20 EMA, right? That's very, very important. That's very, very important. Make sure the price is below the 20 EMA. Now watch for a green volume below the candlestick. So if you remember in the last session, you have to make sure that there is an increase in volume. So that increase in volume is what's going to help you. And that increase in volume is what's going to help you, with trading, right? Because you want to trade an increase in volume. Remember, you want to avoid random candlestick patterns. So I want to show you another example of a random candlestick pattern. So this is another example. If you look towards the screen, just towards the end here, you will see that this hammer here, this is the green bar I'm talking about right here, right? Now, even though there is high volume, right, on this green bar right below the hammer, the problem is the hammer is not touching any of the three moving averages which you're seeing here. So we call these random patterns. So sometimes people will see the gap here and they'll be like, oh wow, this is a good pattern to trade. No, it is not. So this is to emphasize this point I was trying to show earlier on. If we go on top here, like, this is not what you want. You don't want to trade this, but what you want is this, right? You want it to touch the body of the wick, should touch the EMA. This is the one you trade. You don't want to trade this one. So the example is this one here for the first one. I don't know if we can we zoom? I don't know how far I can zoom. Can I zoom it? I don't know if you can see it. Okay. I think I've over zoomed it. There you go. So yeah, right. Sure. Yeah, so as you can see, this is what I mean when I say a random pattern, right? So this is the hammer. This is the bullish hammer, all right? This is the hammer, but as you can see, it's not touching these three moving averages here. Even though the volume is high, right? You can tell that the volume is high here, but it's clearly not touching the moving sorry about that, the moving averages. So this is what's happening here, all right? This is what's happening. So what you want it to do is this is the one that you want to trade. Now remember, we are coming back here. Watch for the green volume bar below the candlestick pattern. Okay, Now, I'm going to show you like how to trade it now, because remember we have seen the right way to to trade it. So I'm going to show you the right pattern to trade. Okay. So now when you come here, let's do this. First, we're going to change this to S&P 500. Okay. So now when you come here, this is what you need to do. Okay, because remember, you're trying to avoid patterns, random patterns, and Team Psych says this. So when you come here on the 50-day moving average, don't say price above 50. You say price crossed above the 50-day moving average. Price crossed above. All right, because this is very, very important for you to note, because remember this right here, right? The wick has to touch. So that's what we're saying, price crossed above. Okay, so the price should cross above the 50-day moving average, and that's what we have done here. So in exchange, you have this type of price pattern. Okay, here it's difficult to see, but we're going to see it closer. Okay, we're going to see it closer. So the key is the price should cross above. Again, let me repeat by saying the word price should cross above. So now I'm going to show a practical example. Yes, so to kind of like close out, I want to encourage you to get so for the free version, you have the Marabozu white, the inverted hammer, you have the hammer, you have the long lower shadow. So remember, the formula is right here, the candlestick pattern. But remember, price crossed above. All right, and then price should be below the 20-day moving average. So this is what you want. Now here's the challenge. All right, this is a similar pattern, but the challenge with this one is the volume. So it's the type of hammer that we have here is a red hammer, right? So the volume is not that high, right? So it's like a pullback on volume. Okay, but this is what you want. Okay, this is what you want. You want the hammer to touch the 50-day moving average. So sometimes the volume may not be high, right? Like in this case, the volume is low, and it was after the earnings report, but it has found support here. So this is the resistance. This is the 50-day moving average. This is what you are seeing here. Okay, that's what you are seeing. What's happened there? The only difference is that here we have used the counter attack candlestick pattern. Meanwhile, here it's the hammer, right? So that's the counter attack. So again, for the free version, you get the Marabozu white, you get the hammer, you get the long lower shadow, the inverted hammer for bullish candlestick patterns. But for the paid version, you get all these plus more. So for the paid version, you get the counter attack bullish candlestick pattern, the counter attack bearish candlestick pattern. That's for if you want to short sell. you want to short sell, you get the harami bullish candlestick pattern. You also get the harami bearish candlestick pattern. You get the rise in three soldiers, bullish candlestick pattern, fall in three soldiers, bearish candlestick pattern. You get the engulfing pattern, which is a bullish pattern. You also get the engulfing bearish pattern. So this is just to encourage you to get FinVs today. So this is an example of a bullish candlestick pattern. So let's see if we can find more candlestick patterns. So Bank of New York is definitely a good one to trade. So remember, it has to touch. Okay, so let's see if we can find something on the Russell 2000. The candlestick pattern has to touch the moving averages. It's very, very important for you to remember this. So this is another example. We have oil and gas here. Okay, we have Remy Street Inc. And these are actually affordable prices. You can see they are $4 and they're more affordable. Russell 2000 has got more affordable, prices. So remember, in this one, so get the elite, right? Get the elite version so that you can have more candlestick patterns. All right, so the one that I would use is this one. This is what you want. Okay, you're going to get more candlestick patterns, not just the hammer. You get a counter attack, bullish and bearish candlestick pattern, the harami pattern, bullish and bearish. You get the engulfing pattern, the bullish pattern. You get the engulfing pattern, the bearish pattern. You get the rising three soldiers, the falling three soldiers, and many more, right? You get many more candlestick patterns. So in this case here, you notice that the body is sitting right there on the 50-day moving average, and this is very ideal. And you also notice a green bar here. You'll notice a green bar, and it's before the earnings report, so that's a very good catalyst. So this one is also very good. RMNI, Rimini Street, right? So ideally it should be below the 20-day moving average, similar to what we said here. Where is that? Right, like what we said here, it should be below the 20-day moving average. Okay, so that's what we have here. Okay, that's what we have here. What is that? So you can kind of see it here as well. So just a second, I'm coming. I just left something on the stove. All right, so that's what it is. So remember, it has to touch the 50-day moving average, and it has to be below the 20-day moving average. So as you can see, this is the ideal you want, where the volume is high, right? The volume has to be high. The problem with that other one that we saw, remember, it had no high volume. That was the problem with that other one. So watch for a green volume bar below the candlestick, right? So this is what you are seeing. All right, this is the perfect example. So that other one, it had no volume bar. All right, it had no green volume. There was no rising volume, right? A rising tide lifts all boats. So this is the perfect example that I can give you right here. Okay, so it has a green bar. Where's the RSI? I don't think we can see the RSI here, guys. Let me see. There's no technical analysis here. Sorry. All right. Let's see if we can look at the technical analysis. But basically, it has to be below the 20-day moving average, right? And that was something we was like supposed to like see. So the cool thing about these is that their prices are very, very low. All right. So let's look at technical here. But before we shift to technical, we have to come here again. Okay, our connection is not too bad. Remember, the price has to be below the 20-day moving average. Just a second, let me just check something on the stove. I'm coming. Oh, we back. All right, we back. Sorry about that. I have to make sure I'm in and out as fast as I can. I have to keep talking or else the stream will cut. All right, now, as you can see here, all right, so we've made sure the price is below the 20-day moving average. Now, this proves the technical analysis part of things. Okay, this proves the technical analysis part of things. So that's what I want to show you now. So if you look at the technical analysis, the RSI, when you say the price is below the 20-day moving average, notice that the RSI here is between 50 and 45, similar to what we're saying here. All right, as you can see from this part here, the RSI has to be between 40 and 60. The price has to be below the 20-day moving average. All right, and then the S&P 500. Now, the reason why I put this red dot was because I wanted to show you that it's possible to change the index. Right, you want to change the index. It's very possible to change the index. Okay, it's very much possible to change the index, and so that's what we kind of have here, right? You have the RSI here. You have a positive change from open, right? So if you want to emphasize the volume, you can just come here and what the hell? Okay. Alright, so on the side here, there's something called change from open, right? So you can just say up. That's all. So what that does is it emphasizes the increase in volume, because remember this part here, right? You want to make sure, watch for a green volume bar on the candlestick. So right now, this is all you're able to get on the free version, right? More hammer, lower shadow, and the invented hammer. That's all you're able to get. All right. Just a second. I'm on my way. So check out this one. This is also another. No, wait. That's the one we checked out last time, right? Anyway, yeah, we can check again. There's no harm. But remember, this is what we are looking for. Okay, this is what we are looking for. Just a second, I'm coming. Let me just check on the stove. I've left some water there. But remember this, I'm coming. Yeah, sorry about that. We back. Sorry about that, guys. All right, so so this is what you want, guys. Okay. So in this case, we're using the hammer. And you can see the body is sitting right here on the 50-day moving average. And the volume bar is green. Okay. Very important for you to remember that. Now remember, on the free version, you're only able to get these three. You're only able to get the hammer, the long lower shadow, the Morobozu white, and the invented hammer. Now I put these two dots here to let you know that these patterns are very rare to find, but they are found in some markets. But the most common one is hammer and long lower shadow. So in essence, you're just getting two candlestick patterns. But for the paid version, you're going to get these candlestick patterns. Okay, that's what you're going to do. So focus on getting the paid versions. That's why you need to get the paid version of Finviz. Check out the link in the description or in the chat. Just a second, I'm coming, guys. I'm coming. So that's what you want. You want to get the paid version of Finviz because with the paid version of Finviz, you will get more candlestick patterns. All right, that's what's going to happen. So now we're going to try and use another pattern. So the invented hammer has worked. Let's see the candlestick pattern and how it looks, so that we can judge whether it's a random pattern or it's a pattern that is tradable. There you go. So you can see the volume is green here, a green bar, high volume. It's sitting right on the 50-day moving average. So basically the hammer is like the main guy here. The hammer is the main key. So sorry guys, I'm eating. So hungry. Mm. I'm actually having my breakfast, guys. You excuse me. But this is what happens. You will get more patterns. Okay. With the paid version, you're going to get more patterns. Okay, so the one that I just showed you is the inverted hammer. Okay, this one. And it's below, it's sitting right there on the 50-day moving average. It's above the 200-day moving average here, and it's below the 20-day moving average. It's a nice green volume. All right, so if you come back here, you have to remember this criteria right here. Okay, so number one, has the price crossed above the 50-day moving average? Let me just do a poll. 50-day moving average, so it should cross or sit. Okay, so as you can see here, the price is like sitting right there on the 50-day moving average. Good zoom. Can I zoom more? I think we need more zoom. More. I don't know how clear this thing will be. Let's get more zoom here. Okay, I want you to see. Okay, we're here to learn. Okay, so as you can see, the price has sat on the 50-day moving average. Okay, so you can see on the moving average is this yellow line here. The price is above the 200-day moving average. Okay, vetted hammer, right? Basically a hammer that's upside down. So what's so powerful about this is that it hit the 20-day moving average resistance and it came back down to the 50-day moving average. So we can change the pattern. Okay, we can change the pattern. All right, it's very much possible to change the pattern, and that's the emphasis I we make sure the price is between the 20-day moving average and the 50-day moving average. So the 20-day moving average is this little pinkish line somewhere here. Then this orange line here is the 50-day moving average. You can see from this side here, pink is 20, orange is 50, then copper is 200 days. So it's in between this pink line and orange line there. So this is what keeps us within the this is what you are seeing here. Excuse me. The price is below the 20-day moving average. This is what you are seeing. Okay, right there. And then so in order for you to see the high volume, you see this green bar here on the day. That's a high volume. That's what we want. All right, that's what we want. So that's basically how the strategy is. So again, in this case, we're using something called the inverted hammer. All right, so with the free version, okay, with the free version, you can get more candlestick patterns here. So you can see the RSI right there. It's between 40 and 60. Means we want it to be oversold. 48 actually means it's it's a good price. Below the 50, RSI. So the inverted hammer is a pretty good, pattern. So the price of this one is $16. So we can change the pattern again. Maybe we can try maybe we can try a different index. Let's see if we can try a different index. Okay. Just check this. That's what you want. So I'm going to try another. I tried the S&P 500. So we're trying the inverted hammer. We'll try the long lower shadow. See if we find anything there. So we have a company called QCOM. Yeah, and the cool thing about Finviz is you can save these screeners. So we're going to save it. Alright, let's save this screener so that next time when we come, we just plug it in. Okay. So I'll save the screener. Excuse me, sorry about that. Sorry about that. Sorry about that. So we've saved this now. Remember this criteria, okay? The RSI is 49. Where is that? Where's that criteria? Here, let me show it to you. Oh, sorry about that. I think the sound was blocked. I don't know for how long the sound was blocked. So sorry about that. Mm, sorry about that. So the sound was blocked. I don't know how much of my sound you could hear or could not hear, but basically what I'm trying to tell you is that if you look at this here, the RSI is between 40 and 60 at 49, right? So just between 40 and 60 at 49, which is the criteria we have here. Remember, between 40 and 60, and the RSI right here is 49. Price below the 20-day moving average, and watch for a green volume bar. So now we're going to look at the price. So if you can see here, the bar is green, right? The bar is green. So we're just going to just dive straight into it, but I want you to notice that there is a green bar right there. Just give it time. Okay. Since you got a long way to go. Yeah. Anyway, I just remember the song flashback. Since you got a long way to go. Ah. Oh my god. So you can see here, this is my shadow, and it has touched the. This is what you have here. So if you look at the low price, its low was 161.67. Meanwhile, the SMA 50 is 161.74. So meaning, which one is lower? Oh yeah. So for the fact that the 50-day moving average is higher than the low of the day, it means the price did touch that support. All right. So this is what you have here. So as you can see, the price has touched the 50-day moving average below the 20-day moving average. We have a green volume bar here. So again, this is the same pattern that I showed you here. Let me see if we can find it. So that's the pattern right there. So notice the similarities between these two patterns, right? So this is what you want to trade. Now in my sketch here, I'm using the bullish counter attack, right? That's what I'm using in my sketch. In my sketch, I'm using the bullish counter attack pattern, and that's what's making all of the difference, right? So I'm using the bullish counter attack pattern, and this is the golden cross. So this is what you want to trade. You want the body or the wick to touch the EMA. All right. This is exactly what you want. So this is a bullish counter attack pattern, which you can get on the paid version. Okay. So for the paid version, this is what you will get, right? The bullish counterattack pattern, which is what you can get on the paid version. So I want you to get Finviz today, because when you get Finviz, you know, you will get the counter-attack bullish candlestick pattern, the counter-attack bearish candlestick pattern. So in the bearish, it's basically just the opposite of what I showed you. All right. Make sure the change is down. Hopefully one of these days I will do a bearish, you know, trading strategy. So you get the Harami bullish, you get the Harami bearish, you get the engulfing bullish pattern, you get the engulfing bearish pattern, falling three soldiers bearish pattern, and the rising three soldiers. So get Finviz today. All right, get Finviz. All right, I want you to get Finviz. So in this case, we're using the long lower shadow. That's what we're using here, and you can see the green bar right here. So QCOM is a Nasdaq company, and I think it's valued at $100. So this is what you have here. So very similar patterns, very similar patterns, and this is what you want. All right, this is the strategy. Okay, so here I say the bullish counter attack pattern must either sit on the EMA with its body, or its shadow must at least touch the EMA, otherwise I ignore the signal. So this is my rule. All right, my rule is it has to touch it, right? It has to touch that. So if you've enjoyed this video, you've enjoyed this presentation, this stream is kind of like a webinar to some extent. So please like the video, subscribe for more content. This I have, like, literally, this is a super master class. I have really dived in on this stream. I have really dived in, and I just want to give you a ton of value at the end of the day. You know, that's what I want. I want to give you value. You know, if you can receive value out of this, then that's what I want you to get. All right, that's what I want you to get. All right, at the end of the day, what I want for you is to, you know, to succeed in trading, for you to learn how to trade. This is what I want for you. This is all I wish for you. I just want you to be very good at trading. Okay, I want you to be very good at trading. So please keep trading, don't give up. Okay, don't give up. I don't want you to ever give up at trading, because at the end of the day, this skill will help you understand the financial markets. All right, it's not an old school skill. It's really not. It's a very new school, and you will learn a lot. You will learn a lot. So remember this criteria right here. Right, so this is the criteria. The price has to be crossed above the 50-day moving average. The 200-day should be below the 50-day moving average. The candlestick pattern should be a hammer or a bullish counter attack. You can choose the S&P 500 index if you want to trade futures, or the Russell 2000 if you don't want to use margin, which is the one I prefer. Make sure it's below between 40 and 60, right? And then for it to be below 40 and 60 RSI, the price should be below the 20-day moving average. Watch for a green volume bar below the candlestick pattern, so that confirms the high volume. So you can see here we're using the long lower shadow candlestick pattern. Hey, I hope you've enjoyed this video. So remember, for more candlestick patterns, get a version of Finviz. All right, this is what you want. So I would love to thank you so much for watching this video. Trade safe out there. uh, Let me know in the comments which candlestick pattern do you like: counter attack bullish, harami bullish, or invented hammer bullish, or the long lower shadow. Let me know in the comments below which candlestick pattern you like. So I'm going to end the stream with this. So remember to get FinViz. Feel